Hey, what's up, everybody? How's everybody doing? Happy holidays, Merry Christmas, Mark. Happy Kwanzaa, whatever you guys celebrate over there in Long Island. What's up, Josh?
Hey, what's up, Jeff? Hey, Mark.
Not much, not much.
Yeah,
PDK, I'm glad you PDK, I'm glad you got in, my friend. What's going on? Yeah, figure out the speaker here. Give me 1 second. All right, all right. How's everybody doing?
I'm good.
What's up, Nikki? We got a good turnout going here. This is awesome. I love to see it. So for those of you that don't know about Zoom at Noon, we actually launched this a year ago today. I had made a post in one of the groups that had like 30,000 members in it about things I did early on in my career. And that's where Zoom at Noon stemmed from. It kind of took a life of its own. So I'm super happy that everyone is going to be on here today, trickling in. We had a really good year, got a lot of feedback. So many great relationships were made off of this. Josh, Nikki, Sherry are all now working alongside of us on the residential mortgage side, learning the commercial mortgage side. And it's really just been a great environment and atmosphere, really for everyone to kind of have a safe space, especially with all the chaos and the unknown. We try and do our best to educate people on what's coming in the market, as well as what we're seeing in the market, hopefully give strategy that mentally and physically and financially prepares you for what's going to take place, right? So if anything, I want everyone to view this as a safe place. We try and do this once a week. We took some time off to regroup, recalibrate, work on other deals that we had pending. But what we've decided to do, and Josh has really spearheaded this, is put together a 1 month game plan in the beginning of every month, right? So what we're going to have today is obviously a 2022 recap. We're going to get into the state of the market, go over some facts, share some new lending programs with you, give some homeowners, accountants, realtors some advice. And then the next 4 episodes are already planned out. So we don't expect everybody to attend every episode. We know it's Wednesday at noon, Zoom at noon. But we'd like for everybody to try and do their best to watch the episodes, bring value, bring questions, bring advice, share your stories, share your successes, share your failures, and really have this be hopefully the #1 real estate related Zoom that goes on a weekly basis. So I'm going to pass this over to Josh Teddy. For those of you that don't know Josh, diehard Pittsburgh guy. Does look like Jason Statham. It's not his relative. He just happens to look like him. Josh, I gave you the ability to share your screen, my friend. Go ahead and let's get started. And if anybody has any questions throughout, feel free to stop us, chime in, give your insight. A lot of people from all over the country here. Really, this is going to be interactive. And then at the end, we're going to have a full open forum and discussion. Josh?
Awesome. Thank you, Jeff. Maybe I am Jason Statham. You guys, maybe I'm just hanging out just in the mortgage industry for now. I'm
Could be. I
done
haven't
with
seen
acting.
any movies lately.
Yeah, that's true. No, hello everyone. Like Jeff said, thank you very much for joining us. I want to take this time to wish everybody happy holidays. Hope everyone had a wonderful weekend with family, and just thank you for taking the time to hang out with us today. Very excited about this. Very excited about sharing some information, and hopefully you guys can get some value out of that. So let me go ahead and share my screen. We'll get started with the presentation here. And give me a heads up or thumbs up if you guys can see the Zoom and Noon screen here. Cool.
I can hear you. Hubert said I can't hear anything. Hubert, maybe you might be on mute somehow, some way. I could hear Josh. Can everyone else hear Josh and myself?
Cool.
Awesome.
Great. Yeah. So like Jeff said, we're going to do a quick 2022 recap, and then what happened in 2022 with a couple key indicators, where we're at right now today at the end of 2022, and then just sort of an outlook 2023 and beyond. So our agenda today, again, just went over it, where we are today, looking forward to 2023. Like Jeff said, this is a very informal, open, conversational type structure. So please feel free to raise your hand or just jump in and ask a question if you have any questions about what we're going over today. And then right at the end, we're going to give away a fun little giveaway. So 2022 year in review. It was quite a year for a lot of different reasons. I'm sure we can all agree. One of the big things that we, regardless of what industry that you're in, that we pay attention to is interest rates. As we see, interest rates kind of went crazy this year. The 30-year mortgage interest rates went up by a little more than 300 basis points throughout the year. And just to give you some greater context to that, in January of 2021, interest rates were at about 2.65. So it was a pretty big shock for a lot of people. There are a lot of things that went into why interest rates jumped so dramatically. And one of those things is the 10-year Treasury yield. So here's a quick little graph on what the 10-year did this year. Now, the 10-year has been historically tied to the movement in mortgage rates. They are not the interest rates, but they've been tied to them. They're a great indicator on what mortgage rates are doing. So essentially, when the 10-year goes up, mortgage rates go up and vice versa. If you see here, this year, it increased nearly 250 basis points during the year. And a lot of things affect the 10-year, but the main contributor are mortgage-backed securities. Now, we all like this word, right? Inflation. We've heard a lot about inflation this year, both the good,
Hello,
both the
this is
bad.
John.
And we're not going to get into the.
Hello. Gravy.
Yeah, can you mute John?
Yeah, I'm gonna try and do that. I don't even know who that is.
You need the 1099 early.
No, what? My, so.
Hey, John
because
Walker.
It's a life insurance annuity.
You're good. Sorry about that.
Good to go. Cool. Awesome. So yeah, inflation. So this is a quick little graph of inflation. I went back to 2020 just to give you guys some perspective on how drastically inflation increased. It was a historical year for inflation. It's obviously had a direct impact on our economy and the housing market. If you look at June of this year, inflation peaked at 9.1%, which is the highest that it's been since 1981. It has since decreased by 2%. So if you look at November, it's down to 7.1 with the December number coming out early next year. And in an effort to combat inflation, the Federal Reserve raised the Fed funds rate 7 times during 2022, which was also a record, by a total of 425 basis points from March to December. Now, the purpose behind the Fed doing this is to combat inflation. They want to decrease consumer spending, which decreases consumer demand, which in theory should bring prices down. So it's called cooling off inflation. Now, we have seen some early indications that it may be working, but I think it's still too early to tell. I think next year is really going to be early next year, Q1, Q2 of next year is really going to tell us a much bigger picture on inflation and if what we're doing is actually combating it enough to positively affect us. And then let's look at the housing market from a supply standpoint. So the number of homes for sale increased 4.8%. There were 1.4 million homes sold in November of 2022, which is nearly a 5% increase from last year. So believe it or not, people are still buying houses, even with all the uncertainty in the market. Number of newly listed homes actually decreased by almost 30%. There were 345,000 new homes listed for sale in November of 2022. Now, this number can be skewed because in general, not a lot of listings, there aren't a lot of purchase transactions happening essentially from November to February, just because of it's out of purchase season, the weather and things like that. But in essence, sellers were less active in new listings throughout the year. One thing to note, there's actually been a downward trend of newly listed homes over the past 5 years. Average number of days on the market, there we go. Average number of days on the market increased by 15 days. So homes stayed on the market an average of 37 days, which is 15 days longer than last year. And if you look at it from a holistic standpoint, if a home spends more time on the market, that essentially means there's less competition and we have fewer bidding wars, which actually gives buyers a little bit more power. And then the months of supply for existing homes increased to 3.3 months. Now, months of supply measures the number of months it would take for the current inventory of homes on the market to completely sell. So it's sort of just an indication on how long homes are actually taking to sell. This has increased 1.2 months year over year, which tells us that homes are sitting on the market longer, giving more options for potential buyers. Now let's look at the housing market from a demand standpoint. Number of homes decreased. Number of homes sold decreased 36%. 380,000 homes were sold in November of 2022, which was a decrease from the prior year. This is a result of the rising interest rates, inflation, overall decreased confidence, and a number of other factors that happened this year. Homes sold above list price decreased 18%. So nearly half of buyers paid above listing price for a home last November of 2021. That number decreased to 26% of buyers in November of 2022, which essentially tells us that there's less bidding wars going on out there. Homes are actually priced more appropriately, and hopefully gone are the days where someone's actually paying $100,000 above listing price, which I'm sure we've all heard those stories in and out this year. Homes with price drops increased 11%. So 21% of homes had price drops in November of 2022.
And Josh, Josh, if I could just chime in real quick. So obviously, look, there's a big disconnect right now between sellers, right, living in 2021 and buyers at the end of 2022, right? There's definitely a gap there of reality. So what we see starting to occur are price drops, significant price drops on overpriced listings. So let's just say the average home was 700,000 last year. You know, a real estate agent may take that listing at 749,000, right? $49,000 or 7% over the most recent sale, forecasting an upward trajectory in pricing. But realistically, prices may have come down 7% in that market. So 700 might now be 651. But meanwhile, they have it listed at 749. So if they drop it by 10%, which is a big number, you know, you're dropping that list price by 75,000. So the data is skewed from a list standpoint because not every listing is priced to sell or priced at fair market value. Many listings are actually on market way above market value. So keep that all in mind.
No, that's a great point. Great point, Jeff. Thank you for that added context there. All right. So, and then the sale to list price ratio was 98.5%. So this ratio measures the sales price divided by list price. A number below 100 indicates that on average buyers are paying less than asking price. And to give perspective, in April of this year, so April of 2022, the ratio was 103.2%. So this is just another strong indication that the market is cooling off a bit. It has shifted from a seller's market to a buyer's market. And then 2022, we saw a lot of things this year. I think we can all agree. A lot of challenges, both from a personal standpoint. If you're a loan officer, less production, having to work twice as hard in order to get less the business, having to create a lot more new relationships, unexpected turns, so things that are outside of our control, so things that are happening with the economy, interest rates, inflation, market corrections, right? So we were so used to 2020 and 2021, which, you know, loans were falling out of the sky, but the market corrected a bit, and that was really difficult for a lot of people to get used to. And just the unknown, again, things are out of our control. You know, what's going to happen with interest rates next month, you know, next year, the next 3 years. However, most importantly, this has created opportunity. And what I mean by opportunity is that over the past few years, the lending industry had to staff up to support about $4.4 trillion in loan originations in 2021. And it's estimated that when it's all said and done, only 2.7 trillion are going to be originated in 2022, which is about a 40% drop in production. And as expected, this has caused a lot of disruption and a lot of pain points, you know, mass layoffs, mergers and acquisitions between companies, departments shutting down, and even whole companies shutting down. So, you know, you saw a lot of these headlines in our industry, specifically with companies shutting down, laying a lot of people off almost monthly. This is the main reason why, you know, companies, in order to take advantage of all of the production that was out there in 2020 and 2021, they had no choice but to staff up in every single department, essentially. However, when that production gets slashed in half, a lot of companies scramble, and if they didn't handle their money correctly throughout those 2 years, you know, a lot of companies are just faced with the reality that they have to lay a lot of people off, you know, shut down departments or shut down companies completely. However, on an optimistic note, what this means is that even though there's less competition, we're all fighting for smaller pieces of the pie, which has forced each of us to challenge ourselves, to improve our skill sets, and create new valuable relationships and partnerships.
And Josh, I want to
Um,
touch on that real quick. So for
yeah.
everyone that's listening now live or going to be watching this, on the recorded version of it, you have to understand that the playing field has been unlevel for quite some time now. I'm going to say dating back to 2013, really dating back to 2017, and extremely most recently dating back to 2020 and 2021, where the big guys and girls, right, got bigger and bigger and bigger and bigger, raised all this capital, tech companies, look at Better, look at Better Mortgage, right? Look at Compass, look at all the companies that raised all this crazy amount of money that are now experiencing mass layoffs that had an unlimited checkbook to spend and compete with you directly in the market, right? So whether you're a real estate agent, whether you're a prospective home buyer, whether you're a mortgage lender, right? The whole iBuyer program, the fact that institutions were gobbling up single family homes and paying $50,000 to $100,000 over ask price based on an algorithm, that made the playing field unlevel. So your regular buyer that wanted to buy a home for their family didn't have a fair shot at doing that to begin with, right? Mortgage lenders, the big guys, were able to do deals literally and make no money, where you couldn't sell a deal, you couldn't sell a rate because everyone was undercutting everybody. Listing agents, look, people are out there being discount brokerages, spending all this crazy money, marketing, advertising, Zillow. So if anything, we all now have, as little fish in the pond, a big opportunity to take market share, because the majority of the competition is going to fall off. They were already falling off, even in a hot market, right? Most people right now that I speak to that did well over the past 2 years have zero loans or deals in their pipeline, right? Zero listings, zero buyers in contract, zero loans, purchase or refinances. And you know where they're at right now? They're on vacation, right? Me personally, I never really took a vacation. I took one vacation the past 15 years, like a legitimate 1 week vacation. I wouldn't be able to leave anywhere if I had no deals going on right now, right? I'd be out hunting for business. I'd be out banging on doors, kicking in doors, whatever I had to do, right? Leaning on relationships from the past in order to get myself a pipeline, right? So understand that the market where we are today, with 3 days left in 2022, you have 72 hours right now to set the tone for forward momentum to go into 2023. So we need to leave 2022 behind us. We need to learn from what happened in the volatility. If you had all your eggs in one basket and that basket got stolen from you, or all those eggs cracked, maybe it's time you diversify a little bit, right? But this is going to be the greatest opportunity to weather the storm for 2023, of which 2024 is expected to be one of the hottest real estate transaction markets, real markets, not inflated markets, in the history of real estate. So weather the storm now, plan, prepare, strategize, focus, and form your relationships. And come 2024, we're going to be off to the races again. But there's going to be pain for the foreseeable future.
Yeah, and just to piggyback off of that, Jeff, all those people, let's use the past 2.5 to 3 years, that jumped into this industry with zero experience and they just wanted to make a quick buck. They are feeling the pain of what it actually means to stick your nose in the mud and actually grind it out. So they're either going to do that, which is going to raise the playing field for everyone, which is a great thing, or they're going to leave the industry, which again, when they leave the industry, it's weeding out those people that aren't really in it for the long term. So those bars are being set even higher and higher for those A players that are sticking it out right now. Like you said, Jeff, not taking vacations, doing whatever it takes to have, create that new valuable relationship, have that conversation with that person that you've been wanting to. And those people are going to be a catalyst for the next stage of creativity and innovation in our different industries.
Absolutely. Couldn't agree more.
Cool. So where are we today? Right now, December 28th, almost the end of the year. Current State of the Union, then versus now. We've seen a downward trend of inflation. So I just went over a couple slides ago. It has been decreasing slowly for the past 6 months. Now, again, I'm no fortune teller. I'm not exactly sure what's going to happen, but a downward trend is a good thing for everyone. We've seen lesser Fed fund rate increases. So the Fed increased the rate by 75 basis points in each of June, July, September, and November. And then in December, they only increased it 50 basis points. And there's speculation that the next announcement, it may be even lesser than 50 basis points. So we will see. We have seen slight mortgage interest rate relief. So since November of this year, the 30-year fixed rate has decreased by about 1%. Supply and inventory of housing are low, which are keeping the values and prices pretty strong, which are helping people maintain equity in their homes. And we spoke about those buyers actually paying for the proper prices for these houses that they want to buy. We're still at an all-time low on mortgage delinquency rates. Just to give you some perspective, in 2010, which we all know that was off the heels of 2007, 2008 crisis, but the mortgage delinquency rate was 13%. And in 2002, it's only 2%. So a lot of lenders, servicers have done a required duty and due diligence to make sure that their book of business that they're lending money to are adequate loans that are going to perform in the future. And then just overall strong lending practices. So again, just to give you some numbers here, from 2002 to 2007, 23% of mortgages originated were subprime loans. Since 2007 through today, 0% have been subprime for obvious reasons. And then the Mortgage Credit Availability Index, which essentially measures how easy it is to get a loan, using 100 as a baseline. In 2006, it was 900, and in 2022, it's just reported around 102.5. So that just goes to tell you that these lenders that are lending out money, in general, as a whole, right, are using stricter guidelines, which is resulting in better loans being originated, which are resulting in lower delinquency rates. And then Jeff, I'm actually going to hand this over to you, man. We're going to look at 2023 and beyond, and just give you guys some advice on how to plan your next year and how to set yourself up for success.
Yeah, Josh, if you want to go ahead and hit the button on the slides and pull up the whole slides, that'd be great. So, look, guys, gold, silver, Bitcoin, say what you want about all three of these things, but, you got to really watch these three indicators. I've watched gold and silver now literally since 2007, 2008, and there are all talks about like the digital currency transition and cash becoming, the actual physical cash becoming worthless because it's just paper and there's nothing backing it. So really take a look at gold and silver. You could search on marketwatch.com or, Google how to track gold and silver and Bitcoin too. Again, obviously these are all what I would consider to be safe hedges against any type of like financial collapse or financial downturn, or even potentially some financial uprooting, right? So just watch those three things. And I expect all three of those in the next 18 months to be significantly higher. There are predictions that gold hits $4,000 an ounce, more than double where it is right now. Silver is about $23, $24 an ounce, I believe. There are talks that hits $100 an ounce, so 4 times. And then Bitcoin, who knows? Look, it can go to zero. There are some predictions that it does go to the $100,000 to $250,000 range, which would be nice. But again, these are all just things to look at, to when you wake up in the morning, check all three of these prices, and then just track the trends. What are interest rates doing? What are gold, silver, and Bitcoin doing? And just start formulating your own thesis. So, as Josh said, overall loan production is down 40% across the board, and that's on obviously a national level. The bigger guys that I talk to, the real players in the lending space, all agree that they're down about 40%. The ones, mom and pop shops, smaller shops, or like the middlemen, they're down somewhere 60 to 75% overall, depending on their prior year's business model. And look, at the end of the day, these are good metrics. I could tell you that 3 areas of my personal lending operation were all up, anywhere from 500 to 800% this year compared to 2021, right? Non-QM, alternative lending, bridge lending, private lending, hard money, all that good stuff, right? So while one segment could be down, you need to hedge against that, right? So if you're primarily a listing agent, maybe you start getting into rentals, right? If you're a rental agent, maybe you start getting into commercial sales and investments and triple net leases, right? If you're only a commercial lender, maybe you learn hard money, right? If you're a residential lender only, maybe you figure out hard money, bridge lending, commercial, non-QM, and everything else. That way, yeah, one segment of your business could be down, but if that's the case, then your other segments might be up. Problem is, again, a lot of people don't really focus on becoming an expert, and they just kind of take the water under the faucet, and then when the faucet gets cut off, they're sitting there with their mouth open with no water dripping into it. So if business does drop another 15% next year, which is very likely due to the gap of reality between buyers and sellers, it could provide to be a lot more pain for everyone in the industry, which is why we believe that the strategy you implement now is going to carry you through 2023 to survive in 2023, to then be perfectly positioned while both the real estate and lending industry dwindle away from a people standpoint. We want to make sure that people are becoming the expert and are positioned to take over market share when the market does rebound. And I believe it's going to rebound, pretty attractively. So one thing that I've seen really for the past 7 months is dating back to May, when interest rates really did surge, blew past 5%, is the inability for investors, landlords, commercial real estate owners to not be able to refinance their current loans, right? Now, again, if you have a $100,000 to $400,000 loan, there's probably some creative way of pulling some strings to get it done, right? We've seen loans ranging from, let's say, $800,000 to even $22 million that we're working on now, that people max cashed out at a 3.5% rate, back in 2017, 2018, 2019. Those loans are all now coming due where the balances need to be paid, and rates are now more than double that in some instances where they can't refinance, right? So we've also seen a lot of people raise a lot of money on the equity side to buy large developments and commercial properties at the 3.5%, 4% rate. Now, if you're lucky, you're getting a rate in the high sixes, essentially that all that equity is gone, right? So we haven't even seen like the real backlash of all that yet. We aren't going to see really the nuts and bolts of it, in my opinion, until at earliest 2024 in that commercial lending arena, that larger scale lending arena. And then we really won't see the worst of it most likely until 2028, right? And the reason why is the cash flow constraints. It doesn't support the ability to repay the loan after factoring all the expenses, right? So DSCR is debt service coverage ratio, which actually is just a key indicator of the ability for the asset itself to repay the debt, right? So in residential mortgages, when you're buying a home, you might have heard debt to income ratio, housing expense ratio, qualification ratio. On the commercial and investment side, while they care about your personal well-being and life and finances, they really only care about the asset, and they look at it as, if we have to foreclose or take this asset back, what are we going to need to do in order to not lose money? So it's really just a simple equation. If anybody's interested in looking at what's called a cash flow analysis, feel free to drop your email in the chat, and we're happy to email you over a generic cash flow analysis for you to play with, just so you could see from your own standpoint. And if you're watching this recording, feel free to email us or message us, and we're happy to send that cash flow analysis over to you, just so you can familiarize yourself with that. Whether you're a real estate agent, right, or you're a home buyer, or you want to get into commercial real estate or buy 100-unit buildings, for example, you really have to focus on becoming an expert in all these crafts, right? So if you're able to run a cash flow analysis for your client that owns a 200-unit rental building and walk through these numbers, you're creating value, you're creating a relationship. Now you become the overall expert. Then you bring someone like myself in, for example, to talk numbers, to talk strategy, to quote interest rates, and find a lender to lend on that deal, right? But this is going to be the elephant in the room. This already is the elephant in the room. Unfortunately, right now, there's a blanket over the elephant in the room. Right now, just a foot's hanging out, and no one knows that it's a real live elephant. So I want everybody to be prepared and understand that if you focus on assets that were purchased or refinanced, large-scale assets, right, from 2017 to 2021, this will be a massive opportunity for you guys to earn. We're happy to co-broke on these deals with you. We're happy to co-facilitate these deals with you, but there are going to be trillions of dollars of loans already as of today that are not going to be able to be refinanced at current interest rate levels. So if you want to try and go out there and make a $50,000, $200,000, $800,000 commission, right? To getting these deals done and restructured, refinance creatively, bringing in private equity, private debt, mezz debt, right? Preferred equity, you name it. Then these are deals that we believe are going to help keep people not only in business, but become industry experts and leaders. And it's not something you can learn overnight. I'm 15 years in and I still learn 1 or 2 things a month, I like to say. But this is going to be where the opportunity is for industry professionals to help people and earn for the next 4 years. So this is all expectations, and also, a lot of the unknown, what's going on in the world as far as is actually happening. But the current 10 years at 3.85%. I was told by a very well-known hedge fund out of Greenwich, Connecticut, that the ceiling on the 10-year is 4.75%, which is 90 basis points higher than where it is today. Not saying it gets there, but if worst case scenario, something happens out of everyone's control, we can see a higher, interest rate lower than 5% on the 10-year, which messes up commercial mortgage loans even more so, right? So keep all these factors in mind, that these are opinions, there are no guarantees, but if you plan for the worst and we fall short of that, obviously, you're gonna be in a much better position. And I'm wearing my Texas Capital Bank hat, who's probably one of, if not the largest warehouse lending provider to all the lenders in the marketplace, probably billions of dollars of warehouse lines, which keeps mortgage banks and non-QM lenders and people in business for lines of credit to close loans and deals. One of their chief officers did tell me that he expects rates to start seeing relief in 2023 as of June, right? So that leaves everybody that's watching this with a 6-month understanding that, hey, things can go very sideways quickly for the next 6 months, but come June of next year, travel, summer spending, vacations, it's one way to stimulate the economy is by lowering the cost to borrow money. So keep all these things in mind, guys. Like I said, this is more information based from very reputable people. We hope we don't get to the 4.75%, but it's very likely that we hit that 4.25% again, which we saw in the future. Josh, next slide. Keep going. So, we saw an article yesterday when we were on our team call that home prices dropped for the 4th straight month, and it's really due to a lack of quality inventory. We are in the process of fixing and flipping a property here in northern New Jersey, and we bought it for $395,000 back 2 months ago almost, and comps for the house, justify the $620,000 value, right? Now, no one knew from looking at the outside of the house that the house needed $80,000 worth of work, right? So yeah, we got a great deal on it. We got it from a wholesaler. We're going to be all in after it's all said and done for about 500 grand, maybe a little bit more, a couple dollars more. But again, comparable sales are 620,000, right? So we do believe that as the baby boomer and older generation starts to downsize, can't keep up with the cost of living, does look to sell, empty nesters that maybe haven't necessarily renovated their properties to like modern day living, we do believe it's going to cause an increase in home renovation loans, such as FHA 203K loans, home style loans, fix and flip loans, construction bridge products that are going to allow people to rehabilitate an asset and either keep it and rent it out or keep it and live in it, for the long term, 10, 15, 20 years, right? So keep that in mind that, Josh, you can go to the next slide, just because there's 2 identical homes and one sold last year for 500,000 in the same, house in the same block, this year is sold for 350,000 that's next door to each other. You don't know the interior condition, so like the Real Deal or like CNN or Fox News or Market Watch, will leave this home prices dropped 30%, look at this statistic. Well, they forget to tell you that, again, the house that just sold for 30% less needs $150,000 worth of work, right? So don't be fooled by headlines, deal with the real pulse of the market. That's why I love these calls so much. I get fired up for them because we like to talk reality, we like to share like real news and not just, you know, misleading headlines and then go back into our bunker and be negative. So we want these calls to be optimistic and share, you know, real life facts as to what we're seeing day in and day out in multiple markets.
Yeah, and to follow up on that, speaking specifically to real estate agents, this is, using this very straightforward example, this is an opportunity where you can really set yourself apart from the pack, because it may take an extra hour to 2 hours of work to discover this information. But if you do, trust me, there's a lot of people out there not spending that extra hour, going the extra mile to figure out why these prices are, why these homes are priced differently, or what are the nuances, what are the details of it. So this is really where you set yourself apart. And if you continue to do that with your clients over and over, you gain this reputation of just being a trusted advisor and being an expert of the real estate in your area.
Absolutely. Next slide. So this is the sentiment that I've been getting from a lot of, again, the major players that are still the main players in this non-QM private lending space. A lot of the guys and girls that jumped into the business to lend blindly, do crazy 100% financing deals, lower credit score deals, inexperienced borrowers. They've all kind of been sidelined for multiple reasons. They've had to merge, they've had to get new capital sources. Again, Texas Capital Bank is actually a close friend of mine at this point. And, we had a great meeting with them at the mortgage banking convention, and they're cutting lines back for people that aren't performing, aren't delivering, aren't closing loans. So we've seen a lot of the middlemen, inflated pretenders in the market that just cleaned up on the market conditions, go out, go under, and have the ability to not lend, right? There's a large group out of the West Coast that broke into New York City during COVID. They're probably the largest construction loan lender on commercial multifamily assets in the country. They only look at deals $20 million and above. They paused their lending for January and December, right? With the hopes of reopening back in February, right? So when you hear lenders pausing lending, there's usually a reason. No one needs to or wants to pause lending unless they have to or they're forced to. It means usually they have loans that aren't performing, or they have loans that they don't think they're ever going to get repaid back on, right? So we believe that Wall Street right now, because obviously everything flows through Wall Street to some capacity, is in a regroup phase. And they saw how much money was made from 2018, 19, 20, 21, and a portion of early 2022 on the non-QM loans and hard money loans, right? From a leverage standpoint and a securitization standpoint, that we believe that they're going to come back full force later on this year or early in 2024, right? When I say this year, I'm basically in 2023 already. I like to live in the future a little bit, so I'm already, it's already 2023 for me. But I believe that these types of opportunities are going to be very, very attractive for many people in this space. So whether you're a borrower looking to borrow non-QM money, or if you're a residential guy or girl looking to learn this space or send us deals, great. If you're looking to, bring on or get in front of large hard money commercial deals, great. These are what these calls are for. I had posted recently that, in the past 3 months, I closed a $15 million 110 unit office to residential apartment unit conversion in Bridgeport, Connecticut, and $15 million on one deal. And we just recently closed an $8 million land loan in Austin, Texas, right? That's $23 million on 2 deals, 2 of the biggest deals I've ever closed in my career. And it came all in the past 4 months. 2 years ago, you could have walked into almost any bank, commercial lender, and gotten those deals done at 3.5%, 4%. But that entire market's dried up. So there is and there are opportunities out there. The key is just becoming an expert and getting in front of those deals and then being realistic on, what the earning capacity is on those deals. But I really think everybody should learn alternative lending and creative strategic financing, because that's going to help you become an expert and really make a name for yourself inside of this industry. Next slide, Josh. So what we did, we broke down a couple little tidbits that we think everyone should be targeting from a business development standpoint and a value standpoint. So if you're a CPA or an accountant, obviously, educate your homeowners. And then if you're a real estate agent or a mortgage person, target CPAs and accountants right now if you're on this call or you're watching this, you probably do file taxes. I know some of you probably don't, which is fine, whatever, to each his own. But you all have an accountant or a CPA or a tax preparer. And I'm assuming that accountant, CPA, or tax preparer only just doesn't have you as a client, right? They have to have at least one other person. So if you can, please, reach out to your people, give them business, get business, from them, have them generate debt schedules for the people that own properties, right? Hey, what are your credit card balances, student loans, what's all your unsecured debt? What do your car payments look like? What are your unforeseen expenses? Like, does your roof need to be fixed? Yada, 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 right? Because then they're able to formulate a debt schedule along with a mortgage statement, give it to you as the expert, and now you're able to help them refinance. Or if they're maxed out, now you're able to say, hey, contact Joseph Rodriguez to sell your property right here in Staten Island. You're maxed out. You got $800,000 of equity. You really don't need this big house anymore. Contact my buddy Joe, let him sell your property, free up some debt, pay off some debt, downsize, and maybe you even rent for 2 years. Maybe you even want to, move down to Florida, get out of New York, get out of Staten Island, whatever the case might be, right? Regardless of where you're located. But I believe that in the next 90 days, CPAs and accountants are going to be the #1 referral source for everybody that's related to the real estate industry if you form the right relationships. So please do that. The first hard money loan that I ever personally facilitated back in 2015, it was a $1.625 million loan, and it came from a CPA that was referred to me by the client's financial advisor. So I think I made like $12,000 or $14,000 on that. And while it did take some work and some begging on my end, again, one referral can make you, 5 figures plus. So please focus on that. Josh, next slide. Financial advisors, again, right now, obviously markets are down, stock markets are down, crypto's down, day trades are down, pretty much everybody that had money in the market's down this year, right? Realistically. And that might be 2%, that might be 22%, right? It might be 32%, it might be 100%, it might be 95%. So everyone's going to be going to the financial advisor to kind of regroup or yell at them or fire them, right? Because of the losses or downward trends you've seen. So if you can get with financial advisors right now, I think a lot of people are going to be moving their assets come year end after they see, hey, my portfolio is down 15%. Like, I gave you my money to not lose money, whatever. If that's what you want to do, great. But network with financial advisors because they have their clients' finances right in front of them, right? So they could help you potentially get you, a client that wants to cash out refinance to buy another property. Maybe they want to cash out refinance for tax purposes, to put more money back in the market because they think the market's going to go up and it's a great buying opportunity, right? So keep all of these things in mind. It's a give-take street. So give a financial advisor, a client, or your own money or your own life insurance policy, right? And then tell them, hey, I really appreciate you taking care of me. I need some mortgage business from it. Like, this is a two-way street here, right? I'm going to give you first, but then I need to start taking. So again, get in front of these guys. They're always looking to grow their business. They're always looking for good, solid relationships. And there's no better way of forming a relationship than giving somebody your personal business first. Business owners, if you own a business, if you're self-employed, if you have clients that are self-employed, have them talk to somebody that knows what they're doing. Come year end, they're all preparing to file their next year's tax returns, right? So, hey, you know what, Mr. Smith, I know you want to write off all these expenses and not paying taxes, but you're going to pay a much higher interest rate. Like, why don't you just file $70,000 a year in income, which you are making more than that? Yeah, pay the taxes on it, get your mortgage, and then you can go back to writing everything off next year. But have these conversations with self-employed entrepreneurs so they know what their options are, and then they don't have to come to you to worry about borrowing money at 8, 9, 10, 11, 12%, right? So become the expert and educate your marketing and referral sources, specifically your self-employed entrepreneurs, your accountants, and your financial advisors. Loan originators, I love this. I did this, really throughout the year, every year, just because when I was heavy in full swing, wanting to be #1 to prove everybody that I could be #1. Get all your closing disclosures or your HUDs that you've closed from your clients. And real estate agents, you guys could do this too. Like, don't be afraid to do this, right? It gives you a great way to reach back out to your past clients. Grab your closing disclosures, your closing statements, and if you have the client's tax returns on the bottom of page 1 of the tax return, it shows you who the accountant was along with their phone number. They legally have to put that on there. Call the accountant up and say, hey, hi, Mr. Smith, Josh Teddy was my client. I closed his mortgage this year. Can I email you his closing statement so that way you can maximize his, tax refund this year? He bought a home. Oh, I just spoke to Josh. He never told me he bought a house. Most people don't share that information. They don't know because they've never had to do it before, right? So take the initiative, be proactive, and now you're in with the accountant. Hey, Mr. Smith, you might want to grab lunch. Let's grab pizza next week on me. Or hey, what's your favorite restaurant? Let me take you out. I know tax season's coming up. Before things get crazy, let's put a system into place. By the way, I closed 25 other people this year. Hey, you mind if I refer them all to you? Right? Like that's a strategy you guys should really focus on. And the rest of obviously the advice is there. All past clients that you closed this year that took out a mortgage, again, whether you're a real estate agent or you own your own home, bought your first property, or you're a mortgage person, call them and let them know that they're going to be receiving their 1098 mortgage interest deduction form. Hey, by the way, make sure you get that to your accountant because that's fully tax deductible in most cases, right? Look out for this form. We're going to be sending it. Hey, let your accountant know you bought this property, you refinance this property, because you are going to have additional tax write-offs. If you could explain to your clients why they're going to be getting more money back in their refund, you are going to be like Santa Claus round 2. And there's nothing wrong with everybody being Santa Claus this time of year. Everyone can use a larger tax refund or a lesser tax liability. Homeowners, this is my number one conversation I have with past clients today, is be realistic about your situation, right? And don't just look at, hey, I have a $200,000 mortgage at 3%, right? Like you need to look at your global financial position. Okay, you have $200,000 of debt at 3%, right? But you have $50,000 in credit card debt at 18%. Let's get you a 30-year fixed rate loan. Let's get all that interest tax deductible. Let's put another $50,000 or $100,000 of cash in your pocket to have for a rainy day so you don't rack up another $50,000 of credit card debt, right? Maybe we get some life insurance involved. So like really become a financial expert, but really be realistic about your situation, right? You could be the most pretty person in the world without a left foot. Yeah, you're the most pretty person in the world, but you don't have a left foot, right? Like, let's look at everything together. Yeah, you're pretty, but if you can't walk, if you don't have 2 feet, we got to get you a foot, right? So we have to figure out what everything looks like from the top looking down, right? And then get everybody in a position better financially. So when rates do drop, you're able to take advantage of that. And your credit cards aren't maxed out. You're not living paycheck to paycheck, and your credit score doesn't drop massively. So keep all these things in mind when you're either looking to refinance or get a home equity line of credit or just have that conversation. And real estate agents, don't be afraid to have these conversations with your past clients that you sold homes to. If you sold homes to a client from 2021 or prior, they 100% have equity in their property, right? It's something. Most people that bought homes in the past 18 months put 20% down, right? So maybe they can't get a great loan, but they can still get a good loan, right? The other thing is 1 out of 4 homes that were purchased between 2020 and 2021, right? 1 out of 4, so 25% were bought all cash. So you have clients right now that are sitting on homes with no mortgages on them that have crazy amount of unsecured debt at high interest rates. Have these conversations. Renters, look, rents are going to continue to increase, and the housing market is less competitive right now because of higher interest rates. So if you bite the bullet now and figure out how to scrape up your down payment, maybe a couple dollars for closing costs, maybe get creative and get a realtor that knows how to structure a seller concession, all these things are going to help you become more financially stable, right? Why are you going to pay $3,500 a month in rent when you could have a mortgage for $4,000? Maybe bring in a roommate, have your family move in, have them, give you a couple dollars to offset the additional costs. But it's always better to own than to rent. But again, there's also nothing wrong with renting. So if you need to rent for another year, please do so. But let's set a plan and budget and work towards accomplishing these goals. So in that way, you can put yourself in a position to purchase a property, in the next 3 months, 6 months, 12 months, 18 months. Real estate agents, you're going to have to work harder to justify your commission. Right now, unfortunately, the consumer is more price and cost sensitive and focused than they are about relationships and service, right? That's why Zillow is what it is. People want to be transactional. They don't even want to necessarily talk to people. One of the guys I coach got into the business about 2 years ago. he said that $15 million of his $28 million of closed business were from online leads that they didn't even want to pick up the phone and talk to him. They just wanted to deal with him via text and email, right? So as the consumer and the younger demographic shifts towards that mindset, you're gonna have to work harder. You're gonna have to really like sharpen your pencil and figure out how to be more valuable when people don't necessarily want that human element, or you're gonna have to get in front of more people in the numbers game and really focus on people that do want that service and human element in order to make and be paid what you're actually worth, right? And don't do what everyone else is doing. Be different. Do what works for you. Everyone tries to copy everybody else. What works for me doesn't work for everybody else, and vice versa. Like the way you stand out is by doing things differently and being unique. Lenders, loan officers, again, do what you could do to weather the storm. I got guys that did 20, 30, 40, $50 million, $400 million in business on my larger scale lenders that literally have 0 loans in their pipeline right now. So guys made $4 million last year in 2021, and as of today, they have 0 loans in their hopper, right? So, most people aren't built to weather storms. Most people just jump ship as soon as they see a storm coming. So you're at that point right now where you got to figure out what you can do to weather the storm. Continue learning and developing your skill sets and explore, as we discussed earlier, other lending opportunities that can keep you afloat until the market does turn and the competitions dwindle down.
Yeah, I just want to add a note here too. Being a loan officer, my entire background was 95% residential. So, stepping into this year specifically, realizing that everyone else is a residential expert, right? Now there's different levels of being a residential expert, but everyone knows residential loans. So one thing that I have tried to focus on is what Jeff is saying, exploring other opportunities, right? Developing new skill sets for new opportunities to lend money. Because if you're a local loan officer, you're competing with every other local loan officer for residential mortgages. But if you're a loan officer who can do residential, commercial, non-QM, hard money, bridge loans, and all those other products, if you become that loan officer that can do everything, so you're going to just naturally get the residential business if you're able to help real estate agents and clients with all these other lending opportunities. So it's one thing I'm really trying to focus on. And again, to me, I love learning new things. And this is just a perfect opportunity to just not stay where I'm at, just learn new opportunities, learn new ways to lend money, sharpening my tools as well, because there will be a time in the future where I'm going to have a conversation with someone and explain to them what I can do. And then that right there just sets the relationship up for future success.
Excellent. So what's next for Zoom at noon? This is really going to be exciting. So January 2023, schedule and topics. And guys, if you have anything that you need help with, or you want us to discuss a topic or put a presentation together, we're happy to do that, right? We want this to be interactive. And again, it's a two-way street. So on January 4th, we're going to be focused on goal setting, how to set goals and hold yourself accountable for them. We believe Zoom at noon obviously is a great resource to hold yourself accountable just by showing up and giving you a nice break of the week. It's kind of like halftime of your week, right? That's why it's every Wednesday at noon. 1/11. So on the 11th, we're going to be talking about how to be prepared for tax season. Uncle Sam, we're calling it, where you can go out and meet with clients, tax preparers, accountants, CPAs, and really get in front of a lot of business. Some people are going to be hit with some big tax liabilities. You want to be the expert to get those referrals, because accountants just want to get through tax season and they want to get their clients out of their way. And if they're owed money or they owe the IRS money, tapping into their real estate assets are a great way to pay back those monies. 1/18/2023. I came up with this concept back. I built it out in 2017. You can go to sellorrefi.com when you want. I created an algorithm on whether people should sell or refinance and how to talk to clients about selling or refinancing. So whether you're a mortgage professional or real estate professional or a homeowner, go to sellorrefi.com. You answer the questions. You can see it when you pull it up. And based on your answers, there's a toggle that moves back and forth in real time, right? So it's pretty cool. So in that way, you don't have to tell somebody, hey, you should really sell your property. It's like, wait, let's go to sellorrefi.com. It's free. Answer the questions honestly as the homeowner, right? And based on your answers, it tells you whether it's recommended you sell or refinance, right? So that's just another trick, a tool that you guys can put into your toolbox to help ease the conversation with somebody and bring value. I can tell you, nobody's ever saw sellerrefi.com before. There's nothing out there that tells somebody what they should do. But again, they're answering what's most important to them, and based on their answers, it tells them what to do. So it takes, your persuasion out of the equation. You can still be an expert, but at the end of the day, if it says, man, you should really sell your property, perfect, I'm your realtor, right? So you line yourself up in order to get that lead and have that conversation. 125, Loan App 101, the 1003 loan application is your paycheck. So this is, again, more industry related focus for mortgage professionals, but also homeowners and consumers or people that want to buy properties, right? Can't tell you how many deals I get from other brokers and loan officers that the application's all wrong, the information's wrong, they just put whatever to fill a field in. And then I actually just had a deal get declined because the client put their wrong address from 2 years ago, which then when they went through quality control, they sparked more questions, and then the lender actually denied the loan, right? So because the address wasn't right, it was a snowball effect, which actually caused and raised more red flags, and the deal got killed, right? So keep that in mind, what you put in, you get out. It's best to have a 1003 loan application filled out by a mortgage professional that knows how to fill out applications, so you ensure your deal has the best chance of closing. All right, guys, my favorite part of everything is the Q&A open forum. So you guys are welcome to take yourselves off mute, ask any questions, discuss whatever we want to discuss openly. If you need any help with anything, feel free to ask. I usually call people out just to get people, rocking and rolling. But does anybody want to start? Does anybody have any questions, thoughts, comments? What did you guys like about this new structure? And what are you guys most excited for 2023? Joe Cordero, I'm calling you out first only because you just popped up. I want to get you on here live if you're available. If not, I see you're speaking, it looks like, and I can't hear you. Anybody else? Anybody wants to kick off the show? Amide, you want to hop on here? Anybody? Eric Sturkin, you want to hop on? Tell everybody what you do.
Sorry, I'll be right on it. I gotta just send an email. I got a closing that was going a little sideways.
Oh man, that's part of the business. Unfortunately, we know it well. Joe Rodriguez, how about yourself? Anybody?
I'll jump on.
I think 2023 is going to be. I'm a broker. I'm a real estate broker. I'm not in the lending space, but I think this year is going. Honestly, I've seen in the last 90 days more investment opportunities pop up than residential.
Absolutely.
I think homeowners are scared right now. I'll be honest with you. I talk to a lot of people every day, and no one knows what to do next. But as far as investors, we're rocking and rolling as if things are great, which I really can't put my finger on. I'll be honest with you. I mean, we're closing stuff, 6.5%, 7%, but we're closing them.
Yeah, and Joe, I think, and that's exactly, I think the difference between like commercial investment experience, seasoned real estate versus homeowners, right? If the numbers make sense, you do the deal. The rate doesn't matter if the numbers still make sense. Whereas it's like, I'm scared, I'm emotional, I don't know what to do, so they freeze.
Correct. The numbers make sense now. They'll make sense when we refi out and get to 4%. So
correct. Think about it. Your numbers are only going to get better.
Only going to get better.
Right.
But homeowners, it's a tough time for homeowners now. It really is. They don't know. They don't know what to do. They're at 3%. Do they sell again to 7%? So, and the equity they built is pretty much absorbed at that point. So what you're making a lateral move, dollar for dollar. You're not upgrading. It's hard to upgrade now.
Yeah, it's a big problem. And I think, again, a lot of people are going to come to terms this year. I think 2023 is that get off the fence year, right? Again, people literally say, I don't want to lose my 3% rate. But Joe, I literally see people that have $50,000 in credit card debt at 18 to 24%, some even at 27%, right? So 50,000 at 25%, what are you paying on that, right? Okay, so now you got one mortgage, which is tax deductible at 6.5% or 7%. It's better than 27%, People need to look at their overall global financial position. Eric, I want you to hop on here. Eric, do you know Joe, by the way? Joe, do you know Eric? You're on mute still, Eric. I know you're getting older now. I've known you for what, 15 years now?
Man, I'm older, but come on, baby.
I thought you, I don't know. I thought
Don't beat
technology was your
me.
friend.
Don't try to beat me up like that right off the bat. My God, I'll still sprint you, brother.
Listen,
Whenever you
you're
want to
still
go.
faster than me. You're still definitely still faster than me for sure. Joe, Eric did a lot of our clients' credit repair in the past. He's been better qualified, does a lot of other things as well. But Eric, what are you seeing on the credit card, credit repair side?
Whew. Well, people are starting to pay attention to it again on the loan side because now they need, I don't want to say they need the business, but before they were, like we went through this whole Zoom already, it was, the faucet was running. So people are paying attention to those deals to get them to the closing table. Now they're going back to the old stuff that didn't or couldn't, potentially buy or even do a refi then. But now it's becoming much more. And again, January, February, March, April, May is crazy season for us because of credit cards. All right. So what ends up happening, people spend a lot of money over the holidays, before the holidays, for November, December, then they get their statements and things start to happen. So this year you could have a trifecta of stuff between interest rates and, all the other stuff's getting jacked up, people not knowing what they're going to do. So, who knows what's going to happen in the white collar market also with jobs.
Absolutely. You're really starting to see companies, corporations, start getting rid of that middle to upper management and then hiring somebody more entry level for, a fraction of the cost, right? So with that, usually does come defaults, right? Divorces, breakups, delinquencies, so on and so forth. So yeah, look, I hope we don't get to that point. I think it's inevitable that we get to that point. Hopefully a lot of like the employee retention credits, ERCs start hitting, which allow some more cash flow to come in. But look, at the end of the day, I'm a big believer as you are in, look, you eat what you kill, right? And if you can't hunt, well, you're screwed because now you're relying on someone else to hunt and bring you back food to kill it, and then you eat it. The majority of people, Eric, and as you know this, and this is the opposite of how you and I and Joe operates, right? And many other people that are going to be watching this is we hunt, we kill, we eat, and we feed others. The majority of the people in the last 2 years have been sitting there like this, just getting food put into their hands without having to hunt or kill. And that's where I think that big disconnect is going to happen, industry related.
I agree. I mean, hunting is, whether you have a sick online game, right? You could have that, you could have followers, and you have that whole kind of scale grow that way for sure. But it's funny to see, I've been out over the last couple of weeks, right? Activity over the holidays. The game of networking is back. And, you kind of got to have that game down within a very short amount of time.
Problem is most people haven't done it. And
most people haven't done it. Most people do it wrong. They're right away saying, oh, well, if you're looking to sell a house, I'm your guy. I'm thinking, dude, really? Okay, I get it. I get all that. But what else do you do? All that other stuff is, especially in the beginning, and I think a lot of people make that wrong. And then the follow-up game, most people are terrible.
Terrible.
As long as I tell everybody SOP, which is standard operating procedure, but I call it seem on point. And all you have to do is seem like you're on point. You don't have
It's
to.
funny, as I'm sitting here, I have $1 million equity line application in for a very well-known media figure, which I'll disclose later on after I close the deal.
Love it.
And I just said, hey, listen, the application was supposed to be reviewed this week. Banks kind of backed up year end. I was told that they'd have an answer by next week for you. And I received the most thoughtful, thankful email just thanking me for being on top of it. They're like, we really appreciate your follow-up. You didn't have to do that. We're in Ghana right now, right? So like, as silly as that sounds.
They want peace of mind, man.
Yeah,
That's
they
why
want, you know
hired
what? She's in Ghana. She's in Africa right now getting an email for an update from someone that she wasn't expecting to have probably maybe ever hear back from, because that's what she's had experience with before, right? So like little things like that cost nothing, that are personal, people appreciate that.
Yep. And again, it's just on it. The text was just on it. That's all you need to say. And then you got everything to do what you got to do, which delegate, you find out where he is from technology. Because, talking on the phone, and most of the time for me is in the hunt, right? When you finally get them, or at least speak to them. That's when the fun comes. Texting too, though, can be a very valuable tool if you're doing it right.
Absolutely.
Most people text too much and then follow up with the text that's just as long. And it's laughable because most of the time you end up just not reading any of it. Either say, call me, right?
Yep. Joe, what do you got? You got something?
Well, that goes back to what you said earlier about people are going to want to be serviced. People have a lot of questions now. And, I'm preaching to my agents, belly to belly. That's how we're going to get through this. You know,
Yep.
last couple of
And
years.
no patience, mind you, no patience. Nobody has patience anymore.
Correct, but you gotta get, I'm preaching to them, you gotta get belly to belly. In the last few years, it was easy. It was real easy the last few years to close a deal without even talking. You could text a client the whole transaction and close it and then text them with congrats. And
Because they're on the beach, they're at their Airbnb, they're making money
It
in
was
Bitcoin,
amazing, but
crypto,
now-
you know, money's pouring in. They could care less. Hey, yeah,
now
whatever, we're
when
getting it
people have
done.
questions
Yeah.
and there's problems,
Yeah.
you have to be their expert. I've been preaching that for I don't know how many years already. You have to be the expert. You got to be on the realtors. You got to know everything. I got to know every aspect. I got to know part of your job, part of the architect's job. I have to know a little bit of everything, and you can't do that via text. You can't convey your knowledge. You can't help them via text. You have to be belly. I call it belly to belly. This is what this business is. Belly to belly. That's how you make your money. You don't make your money hiding behind a phone screen.
Absolutely.
Yeah, and I just wanted, so we've been talking, it's very fascinating to me. We've been talking for the last 15 minutes about things that are just free. Number one, don't have to pay any money for it. And it's just called being a human being, right? Picking up the phone, responding to an email quickly, giving someone an update. Like these, you go on any sort of website or any sort of group or whatever it is, and everyone wants to know, how can I get leads or how can I close loans doing less work because they're lazy? And I just know from personal experience, you'd be drastically surprised how many people just don't respond to emails, don't respond to text messages, don't actually call someone when they say they're going to call them, even if you don't have an update for them. Like you said, Jeff, like you probably made that person is probably blown away that you're just, hey, just a quick update here. There is no real update, but just letting you know that I'm on top of it.
And she
These are
makes
all
$3
things-
million a year on a W-2.
Yeah, like these
You
are
know
all
what I
things
mean?
that are
So, like, think
free.
about that.
You don't have to. You
What
don't
are
have
they
to
doing
pay-
with the mill?
I can't disclose that. It's private information.
They
It's a very
buying a
well-known
property?
person.
What are they? Come on, give us some story about some property in the Caribbean.
It was referred by one of the largest banks that couldn't figure out how to get the deal done. So I structured it as an equity line of credit to get them another $1 million in liquidity to buy their second home investment property, put 25% down and meet the reserve requirement in order to do so.
Very professional, son. Very nice.
Yeah. But Josh, yeah, you're 100% spot on with that, right? It's like common courtesy, human element, like be a human being. If you want to be a robot, figure that out.
Good.
But if you want to be a human being, you're going to get to the next level.
It goes so far right now in today's marketplace, and like I don't know why I'm consistently surprised by how many people don't act that way, especially in what we're doing. Like you said, Joe, people are like very nervous. They want answers. They don't know what's going on. They're in the dark. If you're just that shine, if you're that beaming light for them, and you're just there to be an ear to talk to, that alone right there goes such a long way. So it's such an easy way to just get in with someone, create a relationship, and then the rest is history after that.
Absolutely. Does anybody else, ladies, are there any ladies on this call that want to hop in, talk, share? We're very equality driven here. And right now, unfortunately, I have 3 testosterone individuals, including myself, so 4 that have just taken over the conversation. Does anybody want to hop in and share, talk, anything? Nikki, you got anything for us? Lynn Norris, how about yourself? Sherry, Darlene? Maria, anybody?
If they don't, I'll be testosterone number 5.
All right, you can be that bridge between both of us here. That's fine. Totally
I don't know
fine.
what you're saying about me. I don't know what you're saying about me there, but that's okay. I got a thick skin. So for those of you who haven't met, I'm Mark Lawrence. I'm in the title insurance business, and actually want to point out, and Eric mentioned networking and having to really get down with that again. My word actually for today, it's second time using it in another meeting I was in this morning, is community, and being a part of different communities is really important, I think, in times like this. And I can point to Jeff creating this community, and from this community I got to meet this year Sherry, Josh, Joe, a number of people on this call, and that came from being a part of Jeff's community and Reverify, which we haven't mentioned for imagine that over an hour, and Jeff didn't mention Reverify.
Sometimes you don't have to
He's
say
got the
things,
shirt
Mark.
on. I saw the
Sometimes you
shirt.
don't have to say things.
Right, he's got the shirt on, but Zoom at noon, and I'm glad to see Josh picking up the ball and running with Zoom at noon. It's nice to see that he's laid out some topics, so I think being a part part of this community could be really valuable, in 2023, just sharing info with other professionals, listen to you guys and, what the knowledge that you share, and having good people to call on when you have questions. I mean, that's really, I think, what makes a lot of people better at what they do. And just a good way of getting to know, people within the community. I took a picture of everybody who was on this call, try to reach out to everybody and at least say hi, get to know them. Because if you're not taking advantage of, just the information that's conveyed in these things, but the people that are here, then you're missing, a good part of the opportunity that's being presented to you. So kudos to Jeff and Josh for, pushing and to keep this moving and going. I'm a part of a bunch of different communities and they're all valuable for different, different reasons. I was on a realtor call this morning called Rain Nation, a lot of different realtors across the country sharing marketing, and other tidbits of things that they do. So learn through your colleagues. And Josh, Jeff, as far as who you'd like to see, on these calls, in January and moving forward, let me know and I'll try to spread the word. I think everybody should spread the word because that's how we grow the community and make this even more valuable, to everybody here. So thanks, guys, and I appreciate being part of it.
Thanks, Mark, as always.
Yeah, I appreciate that, Mark. Thank you very much, man.
Anybody else have anything to add? If not, we could end it, hop off. Obviously wish you guys Merry Christmas, Happy Holidays, Happy New Year. Look, I think there are very few communities, organizations out there that actually want people to succeed, and genuinely want people to succeed. And that's what we built this around. We are going to do a giveaway. We're going to do a random giveaway for everyone that was on this call, and Josh will share those results. We have a $20 Starbucks digital gift card, which we'll email to you, which you can download right into your app. A signed copy of the Realtors Cookbook, which is a cool book that I wrote about a year and a half ago at this point, and then a Re-Verified T-shirt. So if you
Cheap
win the
plug.
Re-Verified
Cheap plug.
there you go, Joey. There you go. If I hope you don't win the book or the T-shirt because you already have both of those. Maybe you'll win the Starbucks gift card. We'll rig it. But if you win the T-shirt, obviously we just need your shirt size and the address where to mail it to. If you win the book, obviously we need your address to mail the book to. But other than that, guys, again, I wish you guys the best of luck. Take the next 3 days to really, focus on starting the year off strong, right? If you focus on the next 72 hours, 2023 is going to be that much easier. I hate to tell everybody this, but the first is Sunday. Everyone's ass needs to be back to work on Monday, right? This doesn't fall on a weekday this year. You don't get time off. Everyone kind of got screwed for Christmas and New Year's this year. But again, focus on what you want to accomplish in 2023 and just know that, Zoom at Noon has your back to do that. So again, wish everybody a happy New Year. Look forward to seeing all you hopefully individually at some point throughout the year. And we wish you guys the best.
Yeah, thank you very much, everyone. Appreciate you guys chiming in, and hope everyone has a fantastic week and Happy New Year.
Next time we need some women, some ladies on the call next time to step in and share their 2 cents.
Hey, Jeff.
Yes, sir. How are you?
Pretty good. My name's Hubert. Can you get me on the reminder list or whatever you have the link? Because I got referred by Lynn.
Yeah, absolutely. What's your email address?
It's the one that's Hubert HUOT origin -mortgage. I put it in the remarks already up front, up top.
Yeah. So
Yeah,
what
Jeff,
you do?
I think Nikki has a text.
Okay,
He has an
perfect.
email.
So just so you guys all know, if you guys do want to be on, you can go to zoomatnoon.com and just register. It's free. And then it just automatically uploads you right into our email list that we blast out. And again, we try not to be annoying with it's only for value, right? So the next email blast is going to go out is going to be a recording of this, but we will absolutely get you added to that. What did you think of the call for being on it the first time? Tell us a little bit about yourself.
Oh, I like it a lot. It's optimistic, but it's actually realistic. So that's what you need. I don't need a lot of smoke being blown.
Too much
And
smoke.
I'm ready-
Too much smoke.
Yeah, too much smoke. I don't need that. I already do enough of that my own. I don't need it done to me.
Yeah, I mean, look, I think you make a great point, right? There's a lot of BS out there. Me personally, I've probably gotten duped for, I don't even want to add it up, but let's just call it minimum $10,000 of smoke, right? Everyone's got smoke. Very few people have actual results, right? And very few
Yeah.
people have an actual strategy I always say, like, I get these calls all the time from people, you name it, right? And I'm like, I don't care what you did the first quarter of this year, last year, 2020. I don't care what you did in 2008. I don't care what you did in 1991, right? What did you do in the last 90 days? What did you do in the last 6 months, right? Because if you could show me success in the past 90 to 180 days, then we can have a talk, right? But I don't want to hear what you did in 2021 when it was an unrealistic market. I want to know what deals you've closed, what you've done, what you've succeeded, what you've accomplished since July 1st. Because if you've done something in that time frame, then we could have, an eye-to-eye conversation. But if you haven't, if you're trying to sell me on this campaign that you did last year, it's just not in real time, Joe Cordero, what's up, man?
What's up? What's up? My
Not
first
much.
time.
Hey, welcome, man. What way to pop a cherry?
I know. I've been meaning to join for a while. I used to have my pipeline meetings at 12 o'clock on Wednesday, so that is now over.
Perfect. You got, is it because you don't have a pipeline or because
No,
you just
I have a
to
pipeline.
reorganize?
I am changing processors at the moment, so
Gotcha.
that process is going away. New one coming in, but yeah, I have a good amount of deals still coming in.
Awesome.
I primarily when the rates were really down, I focused on purchase business. I kind of blocked out all the noise. Everyone saying, "Hey, jump on refis, jump on refis."
Sure.
I just stayed on the purchase business, growing my business during those times, and it worked out.
Awesome, man. Proud of you. I appreciate you hopping on too, man. I know we've been meaning to connect for a while, but
I know.
appreciate you hopping on, taking the time to do that. So
Absolutely, I'm glad.
Feel free to have your sales guys, team, clients, realtors all hop on. Again, like hopefully one day you leave a call, bring value, share insight, and all that stuff too. So again,
Yeah,
guys,
yeah.
these calls are open for everybody. So like, don't be afraid to be an outsider. We want everyone to have the floor.
But I'm definitely following you. I mean, I've been dipping my toes in the private lending side, trying to learn as much as I can, reaching out to different lenders. Learning is a lot to know. It's like impossible in a short amount of time, and
Impossible. It's
sure,
getting even harder.
many mistakes are to come, but I'm trying.
Yeah, and again, look, so what we're seeing right now is a lot of like the bigger players, they're actually not even taking broker business or a new broker business in because of the amount of garbage and crap that gets brought in.
Yeah.
I was on the phone with a lender, one of my main lenders earlier this morning, and they're like, we really did a full analysis of the past 60 days, right? And we've spent 80% of our time, right? 80% of our time on 20% of what we actually closed, right? And then we spent 20% of our time on 80% of what we close, right? So, there are a lot of tire kickers, time wasters. I think you're going to start to see really a pullback in who's taking deals and from who. So again, like relationships more than anything, especially like seasoned longevity relationships are going to become even more valuable, right? You could have the best deal in the world, but if you don't know where to place it, or the lender's not calling you back and they're not giving you the proper attention, I can't tell you how many 5-6 figure tickets I've lost out on just for lack of response from my capital source. Right.
Yep, that's
So
happening.
keep that all in mind. Yeah. And again, so what I would say is let's expedite it. I'd rather get a deal done and make 10 grand rather than 40 or 50 grand and we share, right, and close the deal and move on to the next one than make no grand.
I agree. 100%.
So just keep all those things in mind. Like everyone wants a big ticket payday, but some tickets better than no ticket in some circumstances.
Yeah, I'm fine with anything.
Awesome, man. Well, again, I wish you a happy new year. With the best of luck for 2023. Hopefully we could have you on some more calls and get to know each other better.
Absolutely.
Awesome, Joey. Appreciate it. Anybody else got anything before we close out? I think they say like if you don't say it now, like forever hold your peace. All right, guys. Well, I wish you guys again best of luck 2023. We'll see you guys all next Wednesday. You can use the same link. The link is absolutely the same every week. So you don't have to email me, ask for the link every week. Pull back the email, click the link, and we'll see you guys all next week. Again, best of luck. Be healthy. Be happy.
Bye, everyone.
Thank you.